Your next reading is Introduction to Alternative Investment, starting with question number 1. Which of the following is least likely, mind the word, least likely, to be considered an alternative investment? If you have read your theory, you would know real estate is alternative investment. Commodities, yes, alternative investment. But long only equity funds, well, they are considered as a traditional investment. So this is least likely to be considered as an alternative investment. So that makes C to be the correct option. Question number 2. Private equity funds are most likely to use merger arbitrage strategies. Incorrect, because this is the strategy used by hedge funds. Merger arbitrage seeks to profit from buying a takeover stock at a discount to its acquisition price. So this is not likely to be used by private equity funds. Leveraged buyouts, yes. The majority of private equities, it all involves leveraged buyouts. Then why not market neutral strategies? What is market neutral strategy? A market neutral strategy is a type of investment strategy undertaken to profit from both increasing and decreasing prices in one or more market. So you simply just gain by seeing the difference between the high price and the low price, even in the same market or in other markets, to avoid some specific form of market risk. This is normally used by hedge funds. So in this question, we get B to be the correct option. Question number 3. An investor is seeking an investment that can take long and short positions, may use multi-strategies, and historically exhibits low correlation with the traditional investment portfolio. The investor's goals will be best satisfied with an investment in real estate, hedge funds, or private equity. Very straightforward. Hedge fund. Why? Because hedge funds, they usually use variety of strategies, and their returns are less correlated with traditional investments. And of course, they can take long and short positions. So that makes B to be the correct option. Question number 4. Relative to traditional investments, alternative investments are least likely. Again, mind this word. This can twist the question around. Least likely to be characterized by high level of transparency. This is least likely because alternative investments, they're typically involving low level of transparency. So this is least likely. Limited historical return, this is true. Significant restrictions on redemptions, you invest and it will be difficult for you to take your positions out. That is true. So B and C are true. This is least likely. That makes A to be the correct option. Next, question number 5. Alternative investment funds are typically managed actively to generate positive beta return, assuming that markets are efficient. There are many different approaches to manage alternative investment, but most of the time, typically, these funds are actively managed. So that makes A to be the correct option. Compared with the traditional investments, alternative investments are more likely to have greater use of leverage. This is true. Yes, there is a greater use of leverage. Long only positions in liquid assets. Well, not necessarily. They take short positions as well. So this is not true. More transparent and reliable risk and return data. Wrong. In fact, less transparent, less reliable risk and return data. This is incorrect as well. So the most likely situation is A. Compared with traditional investments, alternative investments are more likely to have greater use of leverage. That makes A to be the correct option. The potential benefits of allocating a portion of portfolio to alternative investment include ease of manager selection. Wrong, incorrect. Rather, it is a challenge. It is a challenge to select a suitable portfolio manager for the alternative investment. It is not the ease, rather it's challenge. So this is incorrect. I'm going to cross it out. And at the same time, accessible and reliable measures of risk and return, this is again not a benefit, rather it's a challenge. That is the problem with alternative investment. There are issue of reliability of measures of risk and return. Then it has to be B, and let us convince ourselves that it is B. The potential benefit of allocating a portion of a portfolio to alternative investment include improvement in portfolio's risk-return relationship. Correct. Why? Because these investments, they have less than perfect correlation with other assets in the portfolio. So this results in the overall risk relation return to become even more useful for the investor. Or we should say an improvement in risk return relationship. So that makes B to be the correct option. Next question. An investor may prefer a single hedge fund rather than to go for fund of funds. Why would he go for a single hedge fund? If he seeks due diligence expertise. Now, this is interesting. Remember, funds of funds, they have some expertise in conducting due diligence on hedge funds. So this is the feature of funds of funds, not a single hedge fund. So this is not the reason why an investor would choose a single hedge fund. Incorrect. Better redemption terms. Again, funds of funds, they offer more favorable redemption terms than an individual single hedge fund. So this is again a feature of funds of funds. Then an investor may prefer a single hedge fund because he seeks a less complex fee structure. This is correct. A single hedge fund has a less complex fee structure, whereas funds of funds, it could have a multi-layered fee structure, which could be complex. So that is the reason for C, the investor would go for a single hedge fund, and that makes C to be the correct option. Hedge funds are similar to private equity funds in that both are typically structured as partnership. This is correct. Private equity funds and hedge funds, they are typically structured as partnerships, where the investors are limited partners and the fund is the general partner. So this is true for both private equity and the hedge funds. Why not B? Because under both assets, hedge funds are similar to private equity funds in that both assess management fee based on assets under management. This is not true in both private equity and hedge funds. The private equity fund is the management fee in the private equity fund, basically it is based on the committed capital, right? But for hedge funds, the fee is based on the assets under management, so they are not the same. They do not have the same characteristics with regard to the fee. Then lastly, hedge funds and equity funds both do not earn an incentive fee until the initial investment is repaid. This is incorrect. Because for private equity funds, general partners, they do not earn an incentive fee until the limited partners have received their initial investment. So this is true for private equity, but not for hedge funds. So that's why it is not the right option. An investor seeks a current income stream as a component of total return and desires an investment that historically has low correlation with other asset classes. The investment most likely to achieve the investor's goal is timberland, collectibles, and commodities. Well, if you have read your theory, you would know that timberland offers a stream of income that is based on the sale of timber, of course, timber products. So since these returns are generally not highly correlated with the return of the other assets. So this will fulfill the objective of the investor. Not the collectibles, not commodities. Hence, it makes A to be the correct option. Both event-driven and macro hedge fund strategies use long and short positions. Yes, that is true. Long and short positions are used by both types of hedge funds to profit from any anticipated market or security moves. But remember, event-driven strategies, they use a bottom-up approach. What's a bottom-up approach? This approach seeks to profit from some short-term events like an acquisition or restructuring, some corporate action. So this is specific for event-driven. But when you say macro hedge funds focus on seeking profit from expected movements in some changes in economic variables, macroeconomic variables. So this is specifically for the macro hedge. So what is common in those both, that they go both for long and short positions to generate returns. So that is A to be the correct option. Okay, next question. Hedge fund losses are most likely to be increased or magnified by a margin call. Well, let's say a hedge fund holds a certain position, and if there's a margin call, in that case, the fund manager may be forced to liquidate this losing position in a security. And if this position is large, it may put some further pressure on the security price, resulting the loss could be further magnified, further losses. So margin call can result in magnification of losses, whereas these two, lockup period and redemption notice period, these are in fact good for the hedge fund. Restriction on redemption, such as this lockup period and redemption notice period, it will allow the manager to have more leverage to close the position in a more orderly fashion, and this will basically protect the manager to go for forced sale, and in this case the force could be further magnified. So this is the correct option, A, margin call. This could magnify losses. Okay, next question. The first stage of financing at which a venture capital fund most likely invest is the seed stage. Yes, that's correct. That is correct. The seed stage is basically the first stage at which the venture capital funds invest. And the next to seed stage is what you call the angel investing stage. And then mezzanine stage, this is the stage where the funding is provided by the venture capital funds. Of course, this is the second stage to the seed stage. And of course, this is where the firm is preparing to go for the IPO. So that makes A to be the correct option, seed stage, and yes, that is the right answer. What is the most significant drawback of a repeat sales index to measure returns to real estate? Sample selection bias. Yes, sample selection bias, it's a significant drawback because the properties that sell in each period, they vary and may not be representative of the overall market the index is trying to cover or is meant to cover. So that makes A to be the correct option. Next, compared with the direct investment in infrastructure, publicly traded infrastructure securities are characterized by. Now listen, direct investment in infrastructure, it involves higher concentration risk. In direct investment in infrastructure, it results in greater control over the infrastructure assets. So these A and C, they are characteristics of direct investment in infrastructure. But when the investment is made in publicly traded infrastructure security, it is characterized by more transparent governance, more liquidity, reasonable fee, and of course the ability to diversify across various assets. So this is the feature of of publicly traded infrastructure. So compared with the direct investment infrastructure, publicly traded infrastructure is characterized by more transparent governance, and these A and C, they are characteristics of direct investment in infrastructure. So that makes B to be the correct option. An equity hedge fund following a fundamental growth strategy uses fundamental analysis to identify companies that are most likely to be undervalued. This is incorrect, because the fundamental value strategies use the fundamental analysis to identify undervalued companies. This is incorrect, not the fundamental growth strategy. Then likely to be either undervalued or overvalued. That is incorrect as well, because market neutral strategies, these are the strategies that use either quantitative or fundamental analysis to identify under or overvalued companies. So this is again incorrect. Then of course, fundamental growth strategies use fundamentals analysis to identify companies that are most likely to experience high growth and capital appreciation. And that makes C to be the correct option. Moving on. Which of the following is most likely to be available when conducting hedge fund due diligence? The benchmark used by the fund, correct. When conducting hedge fund due diligence, it should be possible to identify what yardstick, what benchmark has been used to assess the performance of the fund. So this is correct. So A is correct option. Why B and C are not correct? Because hedge funds, they think that their strategies, their systems, their processes, they are their property. They think they have control on them, so they are unwilling and reluctant to provide much information about these to the potential investors. So that's why BC is not correct. A is the right answer. A private equity fund desiring to realize an immediate and complete cash exit from a portfolio company is most likely to pursue an IPO. Will be difficult to exit. Trade sale, correct. This is correct. Private equity funds can realize an immediate cash exit in a trade sale. So that makes B to be the correct option. As the loan to value ratio increases for a real estate investment, risk most likely increases for, well, the loan to value ratio, when it increases, it would result in higher leverage. So basically higher leverage, it is for both for debt investors and both for equity investors. So when the loan to value ratio increases, the higher leverage is for a real estate, which increases the risk to both the debt investor and equity investor. So that makes C to be the correct option. Which of the following forms of infrastructure investment is most liquid? An unlisted infrastructure mutual fund? No, it will be liquid. A direct investment in a greenfield project? Even harder to do so. Yes, an exchange traded master limited partnership. This would provide the much needed liquidity. Exchange traded MLP, they provide the benefit of liquidity. That's why C is the right answer. An investor chooses to invest in brownfield rather than greenfield infrastructure project. The investor is most likely motivated by, you would have gone through your reading, so you would know that brownfield investment is an investment in an existing infrastructure asset. So such an investment is likely to have steady cash flows compared to greenfield, which is a new project in investment. So in this case, the investor is most likely to be motivated by predictable cash flows, because in brownfield investments, infrastructure project investment, the cash flows are consistent, risk is less. They're less risky and they provide better predictable cash flows. So pretty straightforward question. B is the right answer. The privatization of an existing hospital is best described as, since this hospital is existing and we know investing in an existing infrastructure asset, whether to privatize or lease or sell or lease back the asset, it is known as brownfield investment. So this is brownfield investment. So it is brownfield, not greenfield. And an economic infrastructure investment, well, it involves assets such as transportation, utilities, so on and so forth. So that makes B to be the correct option. Next, a hedge fund invests primarily in distressed debt. Quoted market prices are available for the underlying holdings, but they trade infrequently. Which of the following will the hedge fund most likely use in calculating the net asset value for trading purposes? Well, many analysts believe that if an investment is illiquid, like this one, which is infrequently traded, the liquidity discounts are necessary to reflect fair value. So which means there will be two types of NAVs. One would be for trading purposes and one would be for reporting purposes. So the fund may use average cost for reporting purposes but apply liquidity discounts for trading purposes. So average costs are for reporting purposes, since we need for trading purposes. So for trading purposes we will use average costs adjusted for liquidity. That makes B to be the correct option. Angel investing capital is typically provided in which stage of financing? We have just discussed it a little while ago. Angel investing capital is provided at not the later stage, the formative stage. Once the seed capital is provided by the venture capitalist, then of course in the early stage of financing, the formative stage of financing, angel capital is provided. So that makes B to be the correct option. If a commodities forward curve is in contango, what is contango? Contango occurs when there is little or no convenience yield. Now, what about roll yield? Roll yield basically refers to the difference between the spot price of a commodity and the price specified by its future contract. In other words, the future price is higher than the spot price. The commodity forward curve, as you can see, is an upward sloping curve, and this is what we call contango. Contango occurs when there is little or no convenience yield. So that makes B to be the correct option. Then what about collateral yield? Well, collateral yield is simply the return earned on the margin money, but B is the right option. Next question, number 26. United Capital is a hedge fund with 250 million of initial capital. Okay. United charges a 2% management fee based on the assets under management at year end, and a 20% incentive fee based on return in excess of 8% hurdle rate. Okay. In its first year, United appreciates 16%. Now, this is the situation. This is the original investment at the start of the period, and it grew by 16%, which means at the end the valuation is 250 times 1.16. That gives you 290 million. Now, the first thing is that we have to pay a 2% management fee of 290, which will be equal to 5.8 million. Right? Now, what was the hurdle rate? Hurdle rate was 8%. So we were expecting a minimum of 8% of 250. 8% of 250 would give you 20 million. So we thought that the fund would go up by 8%. So it's going to be 270 million. But instead, it went up to 290. So if we deduct 5.8 million from 290 and take the difference between these two, 290 less 5.8 less 270. This would give you the return in excess of 270, excluding this 5.8 management fee. So whatever is left above 20 million, we will have to pay 20% as the incentive fee. And if we do the computation, you should get 2.84. So this is the total fee to the United Capital, 5.8 million and 2.84 combined, it is 8.64 million. Now we need to calculate the net return. So net return is simply equal to 290 less the initial value of the fund less the amount paid as a total fee to United, 8.64, and divide it with the original value at the start, 250. If you do all the simple computation, you get 12.54. Yeah, that's all. That's the percentage. So that gives you B to be the correct option. B it is. Next, Capricorn Fund of Funds invest GBP 100 million, pounds 100 million in each of Alpha Hedge Funds, ABC Hedge Fund. Capricorn FOF has a 1 and 10 fee structure. So fund of fund has 1 and 10 fee structure, means that 1% management fee and 10% incentive fee. Management fee and incentive fee are calculated independently at the end of each year. After 1 year, net of their respective management and incentive fee, the investment in Alpha is valued at 8 million and investment in ABC is valued at 140 million. The annual return to an investor in Capricorn, net of fee assessed at the fund of funds level, is closest to. Now first, the initial combined value of these two funds, 100 plus 100, that is 200 million pounds. Okay. And the end combined value is 140 plus 80, that is 220 million pounds. Okay. Now we have to pay management fee at the rate of 1%, which will be equal to 2.2 million pounds. First thing. Then the incentive fee. What would be the incentive fee? The difference between the value at the end less at start, because they have to be calculated separately. Just take 10% of this value. It will be 20 million times 10%, that is 2 million. Which means the combined fee would be, a total fee to Capricorn would be 4.2 million. Now if you want to calculate the investor's net return, it's going to be the final value funds of funds, 220, less the initial value, less the fee paid to Capricorn, the total fee paid, that is 4.2 million. So that will give you the net return based upon the initial value of the fund of funds, 200. If you do the computation, that will give you about 7.9%. That is A. The following information applies to Rotunda Advisors, a hedge fund, 288 million in assets under management as of prior year. 2% management fee based on the year-end assets under management. 20% incentive fee calculated net of management fee using a 5% hurdle rate and using a high water mark, that is 357 million. If incentive fee would be payable if the value of the fund after the management fee is above 357 million at the rate of 5%. And current year fund returns are 25%, which means your fund at the start had a value of 288 million, which went up by 25%, which means the closing value of the fund is $360 million. And out of this 360 million, 2% has to be paid as a management fee, which is 7.2 million, which means the net of management fee, the fund value falls to 352.8 million, which is clearly less than the high water mark, which means net of fee, the fund does not exceed 357, so there is no incentive fee earned. So the value the management fee, the total fee earned is 7.2 million. That makes A to be the correct option. A hedge fund has the following fee structure. Annual management fee based on year-end assets under management 2%, incentive fee 20%, hurdle rate before incentive fee collection starts 4%, current high water mark 610, which means incentive fee would be paid if the fund value is above 610. The fund has a value of 583.1 million at the beginning of the year. After 1 year, it has a value of 642 million before the fee. The net return to an investor for this year is closest to, first of all, this is the value at the end after 1 year. That will attract 2% annual management fee. So it's going to be 642 times 2%. So it's 12.84. As you can see, the ending value, it exceeds the high water mark. So the hedge fund can now receive the incentive fee. How do we calculate the incentive fee? Incentive fee would be the difference between 642 less what the fund was supposed to earn as a hurdle rate, that is 610, at the rate of 1.04. This differential must be multiplied with 20% as incentive fee. So when you do, you will get $1.52 million. So this is the annual management fee. This is the incentive fee combined will be deducted from the ending value of the fund so as to calculate the net return. So what you are going to do, 642, the end value less 12.84, that is the annual management fee, less incentive fee. So this is the net available for the funds out of the total initial value 583.1. And if you do the simplification, you would get 7.64%. So that makes C to be the correct option. Okay, next question. Ash Lawn Partners, a fund of hedge funds, has the following fee structure. First, 220 underlying funds fee. 220 means 2% management fee and a 20% incentive fee would be charged with the funds with the incentive fee calculated independently. Once done, then Ash Lawn fee, the next layer of fee, are calculated net of all underlying fund fee, the above, 1% management fee based on year-end market value, 10% incentive fee calculated net of management fee. The fund and all underlying funds have no hurdle rate or high water mark fee conditions. In the last year, Ash Lawn's funds value increased from 100 million to 133 million before the deduction of management and incentive fee of the fund or underlying funds. Based on the information provided, the total fee earned by all funds in the aggregate is closest to. Well, let us first calculate the fund fee. Since the value of the fund has increased from 100 to 133, which means the final value 133 will attract 2% management fee. So it's going to be 133 million times 2%, which will be 2.66 million. Done. Then incentive fee. The incentive fee would be 20% of the difference between the opening and closing value. So it's going to be 133 minus 100. The differential will be multiplied with 20%. That will be the incentive fee. So 133 less 100, 33 million times 20%, that will give you $6.6 million. So the total of these two, 2.66 and 6.6, will give you a total of 9.26 million. So we are done till here. Now next, the Ash Lawn fee now. The assets under management at the end of the year, they had a value of 133 million. But out of this, we have already charged 9.26 million, the funds fee. The remaining amount 123.74 will attract 1% management fee. 1% of this gives you 1.2374, right? Then next, incentive fee. Incentive fee would be 123.74 less 1.2374's 10%, which will be, if simplified, give you 2.25 million approximately. Now, since we have to calculate the total fee, so it's going to be this 2.66, 6.6, which is 9.26, and this 1.237 plus 2.25. This will give you the total, the aggregate fee earned by all funds, and this would be closest to, if you add all these, it should be closest to 12.75. So that gives you B to be the correct option. Next, risks in infrastructure investing are most likely greatest when the project involves construction of infrastructure assets. Yes, infrastructure projects involving construction have more risk than investment in existing assets. Why? Because these assets will be leased back to the government. So they will have less consistent cash flows than the investment in existing assets. So that makes A to be the correct option. Next, an investor in a private equity fund is concerned that the general partner can receive incentive fees in excess of the agreed on incentive fee by making distributions over time based on profits earned rather than making distributions only at exit from the investment of the fund. Which of the following is most likely to protect the investor from the general partners receiving excess fee? High hurdle rate. Well, high hurdle rate can possibly reduce the likelihood of excess distribution, but it cannot prevent. So this is not the correct option. Clawback provisions. Yes, a clawback provision requires the general partners in a private equity fund to return any funds distributed as an incentive fee until the limited partners have received back their initial investments. So this will protect the general partners. So that means this would be the right option. Why not lower capital requirement? Incorrect, because management fee are based on committed capital. So that makes B to be the correct option. Next, until the committed capital is fully drawn down and invested, the management fee for a private equity fund is based on invested capital? No. The management fee for a private equity fund is based on the committed capital, not invested capital, right? So it's going to be B, committed capital. That makes B to be the correct option. An analyst wanting to assess the downside risk of an alternative investment is least likely, mind the word, least likely to use the investment's Sortino ratio, value at risk. He will do this and this because both of these are the measures of downside risk. And then if not A and B, then it has to be C. This would be least likely. Why? Because many alternative investments, they do not exhibit normal distribution of returns. So if we assume, let's say if we assume the returns are normally distributed, so then it will result in measures that will lead to an underestimation of downside risk for a negatively skewed distribution. So this is least likely to be true. So that's why C is the right answer. An effective risk management process used by alternative investment funds most likely include in-house valuation. Incorrect. Independent valuations of the underlying position should be performed, not in-house. Internal custody of assets, this is incorrect as well, because just like the above independent valuations, we recommend third-party custody of assets. This can help reduce the chance of fraud. So that means not A and B, then it has to be C. Segregation of risk and investment process duties. That's the absolutely correct option. Investment risk monitoring should be done by someone else like chief risk officer, and this person should be independent of investment process. So there must be segregation between these two roles. So that makes C to be the correct option, and it ends your introduction to alternative investment.